You cannot time the markets, it's impossible. So, how should you decide when to buy? Many people suggest dollar cost averaging, but is dollar cost averaging the best strategy? Look across the sea of YouTube videos and you will see many people telling you dollar cost averaging is the best strategy. Is that true? Watch this video to the end and you will learn what dollar cost averaging is, what lump sum investing is, and which is better. This video will be 100% based on research with real numbers and the results will surprise you. To explain dollar cost averaging, let's use an example. This is Ben, and he has just inherited $10,000. He watched my last video on timing the markets, which is linked above, so he knows that you can't time the markets. He recognizes he therefore has two main options. He can invest all $10,000 right now, or he could space it out over time. For example, he could invest $192.31 every week for the next year. Which is better? The answer depends on what the markets will do that year, but Ben knows there is no way to predict this with any certainty. Since he can't be certain what the markets will do, he chooses to invest $192.31 each week for the next 52 weeks. He won't get the best possible results, but he won't get the worst results either. This is called dollar cost averaging because he's averaging out the cost of his investments over the course of the next year. Maggie received $10,000 as a bonus from work. She is faced with the same dilemma. She also knows she can't time the markets, but unlike Ben, she knows the average total S&P 500 return from January 1871 to July 2019 was 0.0239% per day, or about 9.09% per year. She figures that if the average year results in a 9% return, she should get all her money invested and working for her as fast as possible. She invests all $10,000 immediately. This is called lump sum investing because she invested all of her available money for investing in a lump sum. Let's imagine in this scenario that the year Ben and Maggie invest is consistent with the average year. The results of Ben's and Maggie's investing strategy show Maggie comes out ahead by $451.25 after the first year because her investments had more time in the market. Maggie and Ben compare their investments and Ben is surprised by how much Maggie outperformed him. He argues that, although she beat him this year, it's only because she got lucky. What if the markets had dropped right after she had invested? Most of the time, dollar cost averaging is the right choice. If they did this a few more times, he would come out ahead. Maggie pulls up some research to educate Ben. In actuality, lump sum investing in the S&P 500 beats dollar cost averaging over a 24-month period in 77.8% of all months from 1997 to 2018. To help you understand this chart, when the black line is above the midpoint, it is showing months in which a 24-month dollar cost averaging strategy would have beaten lump sum investing. When the line is in the bottom half of the chart, it is a time that lump sum investing performed better. You can see lump sum was better more than 3/4 of the time, and dollar cost averaging was only better during the financial crisis and when the dot-com bubble burst. If we go back even further and look at 1960 until 2020 in this chart, lump sum investing is still better in 73.7% of all months. And it is even better in 100% of all months if you take a moment to like this video. These videos take a lot of time to research and create, and hitting that button will help the YouTube algorithm get this video out to more people who are interested. Ben next argues that maybe lump sum investing is better for the S&P 500, but for investing in general, dollar cost averaging is still better. Maggie shows Ben this table. From 1997 to 2020, dollar cost averaging underperformed on a 24-month basis between 58 to 90% of the time across emerging markets, Bitcoin, all US stocks, gold, treasuries, and a 60-40 stocks to bonds split. In fact, the longer the period of dollar cost averaging, the more certain it is that lump sum investing will prevail. Research conducted by Vanguard on the S&P 500 found that, over a 36-month interval, lump sum beat dollar cost averaging more than 90% of the time, whereas it only beat dollar cost averaging about 2/3 of the time over 12 months. Ben countered, pointing out that in the data Maggie showed him, there was more volatility in the returns for lump sum investing, which makes it riskier and a poor investment strategy. Maggie explains that if he's worried about risk, he can invest 60% in the S&P 500 and 40% in bonds and still outperform dollar cost averaging, achieving a 0.5% monthly return instead of a 0.3% monthly return. Not only that, but as can be seen in this chart, The volatility of both methods is identical at 2.3% over this time period. Maggie points out that this means lump sum investing is still better and she can achieve superior returns with the same volatility. Frustrated, Ben tells Maggie that she needs to consider valuation. What if she had invested when the markets were already overvalued? If the Shiller PE ratio is high, he would have beaten her. The Shiller PE ratio is a measure of valuation which takes inflation and the business cycle into consideration. Ben notes the ratio only went above 30 twice prior to recent years, once in 1928 before the Great Depression and in the late 1990s before the dot-com bubble burst. With this ratio rising again, he will win next time. Ever the astute investor, Maggie breaks down some numbers for Ben. If they had both used their strategies with $100,000 beginning in any month between 1926 and 2018 in which this ratio was above a 32, lump sum investing still would have won 60% of the time. People often employ dollar cost averaging because they know they can't time the market. Ironically, if you think dollar cost averaging is better than lump sum investing, you are still trying to time the market. As demonstrated in the research in this video, lump sum investing is almost always better than dollar cost averaging. If you want to wait until the right moment or want to dollar cost average because you feel it is the wrong time, you are trying to time the markets and will usually lose money as a result. What should you do instead? If you have money to invest, invest it. It is as simple as that. Only invest the money you don't need for other purposes, but if you have the money, invest it. Don't wait. The sooner you have your money working for you, the sooner you will reap the rewards of those investments. Have you been dollar cost averaging? Has any of this changed your opinion? Leave a comment below. I would love to hear from you. Also, please subscribe to this channel because I will be creating new videos for you every single week. As always, good luck with your investing.